If you've been following the real estate market, you know that we have been faced with a lot of turbulence over the last couple of years. We went from ultra low rates, which made everyone and their uncle rush out and purchase properties, but we also had ultra low homes available for sale, which caused prices to skyrocket. It's kind of like the market was drunk on real estate. Now, this fear of missing out was a huge component of people's decision making, and some people during that time of it all made some really poor decisions that at the time I don't think they really considered. Now, I'm seeing people on social media post various properties that sold a couple of months ago or a couple of months apart at substantially low values than when they originally bought, and unfortunately those people likely made a bad call. Now, I don't want to speculate too much because life happens, but I have heard of stories where people pull the trigger on a house without doing their proper due diligence, all because they were so desperate to find a home. Then the party started to wind down, right? We seen supply chain issues, inflation grow due to overconsumption, and subsequently interest rates rose 7 times in 10 months. But when rates rise, buyers can afford less. And if buyers can afford less, in turn, sellers sell for less than previously. And we see prices start to come down. Now, when I get asked this question of how's the market, it would really be unfair and inaccurate to use a blanket statement of it being good or bad. Instead, it really truly depends on what you're trying to accomplish, right? If you're a seller right now who purchased in February and needs to sell, then you're going to be selling at a loss today because prices are down 19% since February. But if you're a seller who is looking to upsize and have been in your home for the last 5 to 10 years, then there's an opportunity right now that didn't exist in the recent months. Right now, move-up buyers have an opportunity because the gap from one asset class, let's say a townhouse to a detached or a smaller home to a larger 4-bedroom home, the gap between the two is smaller than it was previously, and home prices are actually starting to stabilize. Now, since you've been growing your equity over the number of years, you likely have a solid chunk of money to use as a down payment for that next property to essentially keep your mortgage payments relatively pretty low. Now, I often hear that the market is bad. This market's terrible. And in my opinion, it's not bad. It's certainly changed. And isn't it funny that when the market was heating up and prices were accelerating, bidding against 15 to 20 people was really the normal, making unconditional offers and often making rush decisions. I didn't hear that the market was bad. We used words like hot and up and increase to describe the market. And a hot market, for some reason, creates this fear of missing out and makes you want to buy ASAP. Who doesn't love something hot, right? Hot weather, hot chocolate, hot is cozy, hot is sexy. On the flip side, sales are down, prices have cooled off, we're in a slower market, and all these really descriptive words are having a negative feeling to them. Now, don't get me wrong, the real estate market will never be good for everybody at one time, ever. There are people out there who started their search a while ago and have seen the impact of what the rise in interest rates have done to their purchasing power. Seeing that you can afford a detached home to now maybe only being able to afford a condo is tough. It's very, very frustrating. But there's also first-time homebuyers that are looking in this market right now who are just starting their search in an environment where rates are what they are. And they're just like, okay, I can afford this. I just want to get into the market. Show me where. So if we're able to take the highs and the lows, the corrections and the crash over the last 45 years, the real estate market on average has appreciated 7%. And that's compounded. So if you bought a home at a time where home values were higher than usual and you can hold on to it, meaning making your monthly payments, then long term, you're going to be okay. I think that we as a whole, as a society, have seen how much money our homeowners have made in a short period of time, that now we look at real estate as it's an easy investment to think that you're going to make a quick profit from. But real estate is not like day trading. It shouldn't be looked at such. So if you're risk adverse and want to get into the market, then you should have a plan to keep that property long term, because that's really when you're going to ride out any dips and blips in the marketplace. Now, we use something called a 10-year trend line as a metric to better understand how our market's performing when it comes to home values. So this is a 10-year trend line using the historical appreciation value at 7%, which I mentioned above, to make its projections of where we should be at a certain point in time. Now, the average price of a home since July has been hovering around that $1.1 million mark and remained pretty flat, which is interesting to see because we've seen substantial rate increases during that short period of time. Now, home values stabilize as demand and supply moves in line with each other. And so it's important to note that home prices directly correlate to supply and demand levels, right? And then supply and demand levels are obviously impacted by what's happening around around us in the world, like interest rates, even the war abroad, local and global factors, etc. But back to the supply and demand piece for a quick moment. So I know that many people wish for the real estate market to crash or become more affordable, and many people thought that that was going to happen when interest rates started to rise because it diminishes people's affordability at the end of the day. But home prices have been holding steady for the last couple of months because so have sales. And similar to that 10-year price trend line I was talking about earlier, we also follow a baseline when it comes to sales and inventory. So yes, sales have dropped year over year by about half, but we're actually 30% below that 20-year average, and listings are also down about 27% from that 20-year average. So if sales and listings are both moving in the same direction, which is down, it will put the market into a balanced state, and that's kind of what we're seeing now. So on the other hand, if sales remained the same at what they are now, and we've seen a significant increase in the homes available for sale, we would further see price declines because home sellers would then have to obviously compete with each other to entice a buyer to pick their home versus the neighbor, and that's typically done through values. Then that home sale would set the precedence for that area, and the cycle continues. Yet we're not really seeing that. I think that as we kind of see the effect of the interest rates and as it moves through the economy, we may see an uptick in homes available for sale, but we're still historically very well below where we should be. Now, I also think that the lack of sales isn't because people can't afford them. Majority of the population are homeowners who have equity in their home and can move that equity from one property to another, but many are in this wait and see pattern, so it's creating this pent up demand. Now, the market isn't dead. It is certainly quieter because consumer confidence obviously is a little bit low, and rightfully so. It's been a wild couple of years, which now we're sort of cleaning up after the party's over. If you found an ounce of value in this video, please like, subscribe, and share it with your family and friends. I would truly appreciate it. We are trying to grow this little mighty channel to 1,000 subscribers. My name is Alice Prince. Ciao for now, and we'll catch you on the next one.